Are you sitting on a pile of home equity and wondering how to put it to work? A cash out refinance could be your ticket. Hi, this is Mayumi Alai with Nexa Mortgage. In this video, I'll break down exactly what cash out refi is, how it works, and why so many homeowners are using it to fund renovations, pay off high interest debt, or simply boost their savings. We'll cover the requirements, the pros and cons, and walk through an example so you know what to expect. Ready to unlock your home's potential? Let's dive into the world of cash out refinancing. A cash out refinance lets you replace your current mortgage with a new, larger loan and pocket the difference in cash. It's a way to tap into your home's equity for things like renovations, debt consolidation, or big expenses. How is it different from a regular refinance? A regular rate and term refinance just changing your interest rate or loan term and no cash back. With a cash out refinance, you actually get money at closing by borrowing more than you owe. Requirements: you must have enough equity, usually at least 20% left, in your home after the new loan. Good credit. Typically 620 plus FICO is required, but higher is better. Stable income and a reasonable debt-to-income ratio. The new loan must be in the first lien position. Pros: access cash for any purpose, remodel, pay off debt, invest, you name it. Potentially lower interest rate than personal loans or credit cards. One monthly payment. Cons: you are increasing your mortgage balance. Closing costs apply just like a new mortgage. If home values drop, you could owe more than your house is worth. Loan structure: new mortgage replaces your old one. The difference between your old loan balance and the new loan is paid to you in cash. Repayment is just like a regular mortgage, fixed or adjustable rates, usually 15 to 30 years. Let's say you own a home worth $450,000. You still owe $100,000 on your first mortgage and $50,000 on a second mortgage. You want to do a cash out refinance, and your lender allows you to borrow up to 85%. Closing costs are $6,500. Let's calculate. First, calculate 85% of the home's value. So 450,000 multiply 85% equals $382,500, and then subtract what the borrower owes. So $382,500 minus the first mortgage and the second mortgage is going to be $232,500. And then subtract closing costs of $6,500. It's going to be $226,000. So the borrower will get $226,000 in cash at closing. Today, I briefly explained what a cash out refinance entails. Please keep in mind that terms and conditions can vary among lenders. With over 250 lenders, we're happy to help you find a suitable loan program. If you found this video helpful, give it a thumbs up and subscribe for more mortgage tips. Have questions? Drop them in the comments below. Thanks for watching and happy house hunting.